Good morning and welcome to this Wednesday, August 26th, 2020 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, it was another solid day on Wall Street yesterday. We'll get into all of that in a moment. Got a pretty good show, lots of earnings. Well, actually, not a lot of earnings, but just a lot of really good reactions to earnings last night and again this morning. We'll go through a number of those reports, some really big moves. Got some upgrades. One stock that just, it's in our strong AD portfolio, NIO, upgraded. I think it was Morgan Stanley this morning. And the stock, after having a big day breaking out yesterday, is tacking on even more today. So that strong AD portfolio is certainly being helped there. But let's go ahead and take a look first at our website. For those of you that are new to Earnings Beats, we do have a free newsletter, Earnings Beats Digest. So if you go to earningsbeats.com, you'll see it here on the left-hand side. This gets published Mondays, Wednesdays, and Fridays, usually before the market opens. Normally a topic having to do with earnings, relative strength, something along those lines. Simply type in your name, email address, hit the subscribe button. We'll add you to our list. And I think it'll give you some good trading ideas and introduce you a little bit to some of the things we really cherish at Earnings Beat. Some of the things I think is really important when you trade or invest. Some of the things I think you really need to be looking at. Let's move on. I got the recap from Tuesday here, and you can see the Dow Jones Industrial Average did lose 60 points. So on a relative basis, that group lagged. The S&P 500, however, you can see up about 12 points. The NASDAQ up 86 points. Mid caps down a couple points, small caps up fractionally. So a little bit of a mixed day. The Dow is kind of interesting, though, because the Dow lost ground, but you know, when you look at the changes that are going to be made to the Dow, you don't take into account the stocks that are going in until next Monday. And the stocks going into the Dow were very strong yesterday, as you can imagine, being announced that they're being added to this, this index of conglomerates. And the reason's pretty simple. I mean, when you get added to an index, all of a sudden, there's a lot of mutual funds, or not mutual funds, well, maybe mutual funds, but ETFs, like the diamonds that track the Dow, all of a sudden need to buy a lot of these other shares. So you've got, CRM, Salesforce.com, Amgen, and Honeywell, which are all being added to the Dow, having strong days yesterday, but not being reflected in the Dow. But the companies that they're replacing, ExxonMobil, and Pfizer, and Raytheon, those three were all hit because they're being taken out of the Dow. And so that actually impacted the Dow to the downside yesterday. So it's kind of strange the way that worked in the short term, but the longer term, the Dow will be replacing those three components with the three I mentioned. Looking at the sectors, you can see the XLC, Communication Services, which has been very strong, continued to tack on more gains, new record there. Healthcare, been sideways consolidating. It is still in breakout mode. It broke out above that June high, but simply going sideways, not really doing a whole lot. So on a relative basis, it has not been performing very well. On an absolute basis, it's still fine, technically. Technology, this one is looking good on both absolute and relative basis, continues to move higher. And consumer discretionary, I have to say right now, is, if it's not my favorite group, it's right up there with technology. Discretionary is seeing more and more of its component industry groups breaking out. Another one is set to. I'm going to talk about that one in just a minute. And then we've got energy. Energy led for a day or two, and now here we are talking about it on the bottom of the sector leaderboard again, losing 1.4%. Just can't seem to get going. We do have crude oil now over $43 a barrel, but it's just, even though the price has been moving up, I think we still have a supply issue, and energy just can't seem to get going. Just mostly sideways, but that's not good in a market, especially a secular bull market advance, where we have seen, look at these other areas over the past 2-3 months, for the most part, up substantially. Energy not doing that, doing the exact opposite. So money there for those who like to diversify and want to be part of energy and, every quarter keep reallocating more and more toward energy, I'm not a big fan of that strategy. I think everybody who follows earnings beats or has followed me over the years knows I'm not a huge proponent of diversification. To me, diversification means you're just putting a lot of your money in areas that aren't working, and that doesn't make any sense to me. Somebody maybe who doesn't follow the stock market at all, then it's better to be invested than not invested. I'll go there. But if you're following the market, why invest in a group that is doing this when you can be invested in groups that are doing this? So that's what I would just be a little cautious of there. I think energy continues to be that primary laggard in the market right now, and a group that I personally would continue to avoid, except the renewable energy component. That area is still very strong. All right, let's move on to the 10-year Treasury yield. Do have a couple report. Well, basically it's one report with a couple numbers. The July durable goods number out this morning. The actual number came in with a rise of 11.2%. The market was only expecting 4.3%, but the majority of that was due to transports, because if we strip out the transports, the actual is 2.4% rise versus a 2% estimate. So taking out transports, the number's still positive, but just slightly better than expectations. But with the transports in there, a huge beat. And we've been talking a little bit about the transports and how strong they've been. And this is, just I think one of the things that's maybe a fundamental piece of news that's coming out after the fact. Remember, this is July durable goods, and July durable goods ex transports. But the 10-year Treasury yield starting to move up. This is what I wanted to see. Unlike what we saw in June when we had the spike in the 10-year Treasury yield and then we went down right back through the moving averages and stayed below. Do you see the difference here? We came up, we came back down, tested both moving averages, and now if we can get this breakout, this would be the first really bullish sign that I've seen in money rotating away from Treasuries. In my opinion, it'd be the first one of 2020. You can see huge move here back in mid-March, but we went right back down below it. That's not what you want to see. Again, as I mentioned, we saw the same thing back in early June, right back down below it. If we can get this breakout, I think it's starting to show money rotating out of the bond market, and that money is moving into stocks. Not only is it moving into stocks, but I want to show you the IWF versus IWD, which is the growth versus value. Because if we pull this chart up, notice, first I want you to notice what happened at the beginning of June. You see mid-May to June, this move down. That's when value was outperforming the growth area. And at the same time, from mid-May to early June, the 10-year Treasury yield was going up. So in other words, money was rotating out of Treasuries, out of the defensive Treasuries, but it was going into value stocks, not into growth stocks, into value stocks. The one difference here is that as the yield is starting to bounce and looks better, in terms of money rotating away from Treasuries, we now have the well, you can see the growth versus value is moving up with the yields. So now money is rotating out of Treasuries, but it's fueling a further advance in growth stocks, which I find very interesting, because if that money coming out of the more defensive Treasuries, if we do get this rotation, I've been calling for this rotation to help fuel a massive rally. And you don't need to see the 10-year Treasury yield go from 0.65% up to 5%. That's not what I'm looking for. If it goes from 0.65% to 1 or 1.25 or maybe even 2, that rotation, I think, would fuel a massive move higher in the stock market. And that's what I believe we're going to get. I think we're in the midst of a melt up. If anybody hasn't been watching, that's really what we've got in the growth area. Value, we're starting to see other stocks begin to participate. More and more groups breaking out on an absolute basis. But on a relative basis, they're still not outperforming. To get that relative strength, you've still got to go to the groups, for the most part, that have been leading since this pandemic began. You still want the autos. You still want broadline retail. You still want specialty retail. These are areas in the consumer discretionary area that have been leading. These are growth areas, And they're also areas that have been benefiting throughout this pandemic. So keep a real close eye on the IWD relationship if the 10-year Treasury yield breaks back out again. It's going to be a really important thing to watch. So right here, are we going to make this breakout? And if so, are we going to benefit? Is that money rotating going to benefit growth over value? If so, we could see another big leg to the upside in growth. All right, talking technically, I wanted to go through and just point out specialized consumer services. I've been talking about this group. I think we've got a very bullish flag after a flagpole. So there's the nice move up. Here's the sideways consolidation. A breakout is not only a short-term breakout, but also a breakout above that February high. And if we go back, use the weekly chart, 5-year weekly chart, you can see that actually on an intra-week basis, we have made that breakout. And we're just simply pulling back, consolidating in this flag. But the next move up, I think, is a clear breakout in specialized consumer services. This is just the latest of a lot of industry groups that have been breaking out in the consumer discretionary area. So I thought what I would do is zero in here and maybe break down consumer discretionary a little bit. So let's do a little breakdown there. First of all, if we just pull up the XLY, I showed it top of the show in that candle glance form, but you can see the XLY. We haven't even had a 20-day test since July 14th. So we're going on probably about 7 weeks now since our last 20-day test. We are just rising. The 20-day is rising beneath, the 50-day is rising beneath that. Great configuration. You go down and look at the accumulation distribution line, breaking out PPO, which had been moving lower back in during this consolidation. On this breakout, the PPO is setting new highs again. And I don't go from, when I look at PPOs, MACDs, whatever, I'm not looking here all the way back here. And the reason's pretty simple. I think that's a big mistake that a lot of traders and investors, technical analysts really make, is by looking at this and calling this a negative divergence. I mean, if you were simply looking at that, you'd be looking at a negative divergence here. And when we get a breakout, another negative divergence, and then it keeps moving up. And now you can see from here to here, you can see we're starting to accelerate again to the upside. Now from here all the way back here, we got a negative divergence. But think about this. The PPO, if you look, it is based on this is a 12-26-9, which is the 12-week versus 12-day versus the 26-day moving averages. That's what you're comparing when you come up with a PPO. You're looking at the percentage difference between the 12-day EMA and the 26-day EMA. How far back does that PPO go? 26 days. With 5 trading days in a week, we're talking about 5 weeks. When you're looking at PPOs, to look back from this period all the way back to June, that's clearly way more than 5 weeks. That's like 10 weeks. So you're taking a PPO here, right here, versus a PPO up here that has no common data. This PPO, all the data that went into this PPO, none of it is included in this. I don't think that's appropriate to be comparing those PPOs. That's the way I look at the PPO. And let me give you even more ridiculous example. If you go back and look at the NASDAQ 100, and I'm going to pull up a monthly chart. And I think this is going to be an extreme case, but hopefully you'll understand where I'm coming from after seeing this. Look at the PPO back in 2000. PPO was up at 30. Okay, first of all, in order to get a PPO at 30, the difference between your 12 period and 26 period moving averages has to be 30%. That's almost unheard of. I mean, rarely do you see a PPO get to 30. So when we finally made this breakout in 2015, should we have been looking at this as a negative divergence? The PPO is only 10. The PPO back here was 30. Have we been in a negative divergence now for the last 5 years? I mean, look, we still haven't gotten to 30. Does that make any sense to anybody? So I guess my question is, if it doesn't make sense, at what point do you stop looking back at prior highs? For me, it's just the data in, if you're looking at a 12 and 26 month PPO, then go back 26 months. 2 years and 2 months. But if you're looking at a daily chart, like we are on the, let me pull this back up again, on the XLY, if we're looking at a daily chart, again, where do you draw the line? At what point do you stop going back and calling this a negative divergence? And I see technicians doing this all the time, and I just don't understand it. I don't think this, to me, is one of those situations where you just look at the line and you don't really think about what the line means. Technical analysis, to me, is not just reading lines and saying, oh, this line's pointing up, I'm going to buy, or this line's pointing down. It's using some common sense. I see the PPO here rising. I see the momentum strengthening. I see confirmation with price action above the 20, above the 50, with accumulation distribution rising. I think to look back and say, well, now we've got the negative divergence still, this long period here, negative divergence, I think is just, it's trying, I'm trying to think of the bias that's in play. I know Dave Keller from Stock Charts talks about it a lot, but when you've already got a bias in your head that the market needs to come down, and so you're going to look for anything. And so every time we get a breakout, you're going to point back, well, we still got a negative divergence. It's got to come back down. And it just keeps you from following the trend and from, participating in the market. So anyway, I kind of got off on a tangent there, but I thought it was worth mentioning. Let's move on to the other areas of the consumer discretionary area. And I want to just point out, these are the 6 areas of the market, or 6 areas of consumer discretionary that have the highest scooter scores. So I'm just going to walk you through and take a look at these charts. I mean, you've got autos continuing to move higher. You've got broadline retail. This was a beautiful ascending triangle, by the way. Equal highs, rising lows, make that breakout. This measures up about, 300 points, probably maybe a little more than 300 points. So maybe it's 3550 is the measurement. And that's just an initial measurement. That doesn't mean it's going to stop there. But I would be looking for probably another 7%, 7 to 8% from where we are right now, just based on this measurement of the breakout. Then we have home improvement, which has been on fire. Look at this move up. AD line continuing to move higher. All 3 of those groups looking great. Home builders. I mean, you talk about a group that came back to life. This was a group that was actually in our weak AD chart list. Many home construction stocks back here were in our weak AD chart list because the group was crushed and the AD line was moving down. Even when we started to rally initially, the AD line went and put it in a new low. That's why they were in the weak AD chart list. But this is a group that if I was going to make changes to my strong and weak AD chart list, this is a group that definitely would be out of the weak AD chart list. And now look at the AD. It would probably be in the strong AD chart list. Not too many groups have done this, but home builders made that big switch. And so this is a group, and it makes sense to me. Low interest rates, the economy's picking back up. And I don't know if you've been following these economic reports that have been dealing in the housing area. My gosh, new home sales. I even talked about that, I think, on Monday during the show. And I said, they're expecting a slight drop in new home sales. I was like, I don't see that based on every other home sale or all the other home building reports that we've been seeing. And sure enough, at 10 a.m. Monday, the new home sales came out and it blew the number away. It was over 900,000. Market was looking for 774,000 or something. So this continues to be a very strong area of the market. How about specialty retail? Specialty retail continuing to power higher. I mean, all of these groups not only are leading the S&P 500, but these are all groups that have broken out and have been in breakout mode for a long time. Specialty retail broke out above the February high all the way back in the beginning of May. S&P 500 was nowhere near its high back then. But the market tells us things if we'll just listen to what the market is telling us. If you follow technical analysis, you're not going to get any of this in fundamental reports. You're not going to, and I'm a, former practicing CPA. My background is fundamentals. I still love fundamentals, don't get me wrong. But in May, the fundamentals aren't going to tell me much. The technicals were telling me everything. That technicals precede fundamentals. I don't care, whether you're, got a master's in accounting, PhD, whatever. Technicals precede fundamentals. I'm sorry to tell you, but that's the way the market works. And it makes sense. You've got companies, you've got very, very, very bright people on Wall Street. You might not like them sometimes, but they're really smart people. And they're going out and they're meeting with companies. They're finding out which companies are doing well, which ones aren't. And you see it in the price action before the numbers come out. Also, last group I wanted to point out here is the recreational products group. Another very strong area in the consumer discretionary space. And we've been seeing some consolidation. This is a group that hasn't been performing well here in August. So what does that mean? That means that's an area I'd probably be thinking about taking a look at for some individual trades, because it's still one of the strongest areas. It goes through periods. It did this back in June and early July, where it just kind of, doesn't do as well as the rest of the market. And then it breaks out. And then it goes through this period. And if you're willing to be patient and accumulate some of the stocks maybe that aren't participating as well, some of the leaders in this group, I think when we get the next move to the upside, you'll probably be handsomely rewarded. All right, earnings spotlight. I want to get into some of these earnings reports while we still have some time. And I mean, the numbers have just been, some of these numbers are just crazy in terms of the reactions that we're seeing. We're not in the middle of earnings season. We don't have hundreds of companies reporting, probably only about a dozen that I looked at. But man, some of these reactions have been very positive. Salesforce.com expected to earn 67 cents. How about $1.44? How about $1.44? A lot of the bears were worried about earnings reports. I'm telling you, these companies that are really performing well, they are blowing these estimates out of the water. And in a low interest rate environment, they're getting melt-ups. I think CRM, Salesforce.com is going higher. Now, will it pull back a little bit after the open? Maybe. That's probably the hardest part about earnings and gaps, is not knowing exactly what they're going to do after they gap up. But there's no doubt with this kind of an earnings beat and this kind of a market reaction, it's going on our chart lists to wait for better entry points. And that better entry point might be tomorrow. It might be in mid-October. I don't know when it's going to be. But the whole idea is to do your homework, find these companies, put them on these chart lists, and wait for better opportunities. And some of them won't come back. I mean, there's people probably still waiting on Tesla. Tesla's not coming back. It just keeps going higher. Salesforce.com might do the same thing. We've seen Wayfair, another company, just seems to not want to pull back. They're melt-ups. Much better than expected earnings in a low interest rate environment, money rotating away from value, looking for growth, and it is absolutely creating a melt-up in many of these stocks. But anyway, Salesforce, great reaction there. How about Intuit? Intuit expecting $1.21, $1.81. That's 60 cents a share higher than expected, 50% higher. CRM was over 100% higher. All of a sudden, these future earnings projections have to be adjusted. I mean, if the company's management teams are bullish and they're saying, hey, we're raising our guidance, or Wall Street decides to raise it for them, valuations are going up. Intuit up 6% pre-market. Now, Autodesk had a beat, but almost maybe it seems almost disappointing, 98 cents versus 90. I mean, yeah, they beat, but where's my double? Where's the 50% beat? I still think the chart looks good. Big move up, sideways consolidation. Probably going to go down maybe and test this 20-day moving average, but I suspect we'll bounce back to the upside. It's just not a leader right now. HEI, which is Heiko Corp, stock pretty flat after its earnings, 40 cents versus 30 cents. How about Toll Brothers? Toll Brothers, 90 cents versus 69 cents. Stock up 2% after hours. And that's after the stocks run from 30 to 45 in just the past 7 weeks. So 50% move in 7 weeks, you might think buy on rumor, sell on news. News is out, and we're seeing still another move to the upside on Toll Brothers. One of the worst performers this morning after earnings is Pure Storage. PSTG is stock down 12%, 1462. Looks like it's breaking down out of this pattern. I mean, unless we get a big reversal here, this one is definitely, I would say at this point, in a confirmed downtrend. You break down, you test support, you go back up, you fail at your 20-day, and then you lose. It's really a head and shoulder pattern. Left shoulder, neckline, head, neckline, right shoulder, and breakdown with earnings. It's going to be big volume. So unless you get a big reversal on Pure Storage, this is one I would avoid. JWN, this is Nordstrom, down 3%. The stock missed its expectations. Look at the way Nordstrom's has performed. What do you think Wall Street's telling us? It's telling me to stay the heck away from this stock. I mean, since the April or March low, the stock market, all the major indices are up crazy amounts. Nordstrom's gone nowhere in an environment where we've had a runaway secular bull market advance. So relative strength is just horrendous. They came out, they missed. They lost $1.62. The market was expecting a loss of $1.47. Stock getting hit pre-market. Urban Outfitters actually had a big surprise, though, to the upside. So here you got Urban Outfitters up 21% pre-market, easily clearing that June high. The stock's been trending above its 20-day. It's beginning to show much more strength. Certainly not going to hurt when you come out with a profit of 35 cents when the market's expecting a loss of 33 cents. That's a turnaround. URBN, big rally, at least at the open. Now, a stock like this, I definitely am not interested in jumping in at the open. Not one that's been an underperformer for a while, even though it is showing more positive characteristics. I mean, if it's going to open up here, I've got to wait on this one for sure. Not that there aren't too many stocks I would be jumping in with a 20% move, unless it's just, maybe Tesla when it's breaking out and it's got a ton of short interest and, you're looking for that short squeeze. There might be some special situations, but for the most part, to be a little careful. All right, I haven't even shown you the best one yet today. And this one wasn't what I would consider a huge earnings beat, but Anaplan, and this is a company that I featured on the Earnings Beats Digest, our free newsletter, right here when it was at 42.5, testing all of this support. I said this, and maybe it was the reversal. I don't remember. Maybe it was trading 44. But right in here at the bottom is where we featured it. Stock started making the move, came out with earnings. Look at this, up 27% today with earnings, now trading up at 60 and change. Featured on our Earnings Beats Digest newsletter, our free newsletter, just above this support area just 2 weeks ago, 2.5 weeks ago. But this one is another one that was going sideways off of an uptrend, but this time we get the breakout to the upside instead of the downside. Another one, Dick's Sporting Goods, up 14% today. Moving up, sideways consolidating, breaking out, sideways consolidating, another breakout, 14%. Dick's came in, expectation $1.24. You ready for this one? Earnings $3.21. $3.21 versus $1.24 expected. I mean, the numbers, folks are out there. I don't understand why the PEs are high. Well, I don't know what to say. I mean, when you got companies that are blowing these numbers away, raising guidance in a low interest rate environment, I mean, this is nirvana. This is a melt up. And I think, again, I believe we're in the third or fourth inning of this bull market. I think we're going higher. Now, are we going to go up 70% every 4 months? No, of course not. We were coming off of a huge move to the downside. We recovered. We've broken out. I think it'll be still a nice advance, but, I wouldn't be looking for 70% over the next 3 to 6 months. All right, let's move on. Just wanted to mention a couple of stocks here. First, NEO, I mentioned at the top of the show, upgraded by Morgan Stanley. Look at the breakout yesterday, over 300 million shares, or right around 300 million shares. There was your breakout. The stock in, pre-market, I think was up pretty nicely again today. Another 7%, 19.11. And again, this is one of the stocks in our strong AD portfolio, so this is definitely going to help our portfolio. And that's the whole idea with our portfolios, by the way, is we put 10 stocks in each one, equal weighted. And generally, it's usually a couple of stocks that just have big quarters and carry our portfolios. We saw that with Tesla last quarter, 130% or whatever it was. And so maybe NIO is going to be the one that carries the strong AD portfolio this quarter. I don't know. One stock that was initiated today with a buy is Shopify, another portfolio stock of ours. Oh, we must have just opened. Shopify, you can see right here. Let's pull up the chart. Getting a little bit of a move to the upside, up 1.29%. Still's got to get up above that 1100 level, a little over 1100 to get a breakout. But anytime you get consolidation in this stock, it's been a great performer. I like Shopify. It's one of my favorite software stocks. All right, let's take a look at the 3 you must see, and we'll wrap this thing up. Start off with Chegg, CHGG. Stock, I'm not sure if this one was, I think this one was initiated. I think it was initiated with a buy or an outperform. But the stock actually coming down printed a, looks like maybe a piercing candle right at the 50-day moving average. First 50-day moving average test you can see over the past several months. So this is an area where I would have been expecting a reversal. And if we get an update here, see what the stock's doing. It is moving a little bit higher today, up 1.5%. Next up is, oh, I had NIO. I'll tell you what, let's do it. Let's already looked at NIO. Let's look at Roku. So Roku was upgraded or initiated, I think, with an outperform, and it had pulled back, has been sideways consolidating in this range for a while. This is another one that just recently I discussed on the EB Digest newsletter, our free newsletter. And here it is, attempting to make a breakout out of this consolidation. It's in an uptrend. I think we got a shot here, maybe at a cup. Maybe we head back toward that 170 level. But Roku doing well. And then the last stock I wanted to show you, here's a company that will be reporting after the bell later today. And this is Splunk, another software stock. Trying to make a move up. Looks like a little cup. I don't know if we get the breakout with its earnings, but one of the things I would be looking at is the market reaction. The high, the candle body high has been 217.30. We're at 210, almost 211 right now. I would wait and see how we open tomorrow, but after we get the earnings, if the earnings are strong, if we get a gap up above 217.30, in my opinion, that's bullish for Splunk. All right, quick update of the market, and then we'll wrap this thing up. Currently, we've got the Dow down 44, NASDAQ up 2, S&P up 2, NASDAQ up 52. And we're seeing that rotation once again toward the NASDAQ stocks. Both small caps and mid caps are slightly lower today. That's, money continues moving into the growth areas, into the NASDAQ. When we put the portfolios together here recently, that was one of the biggest question marks. And still, with September right around the corner, I worry a little bit just because normally value stocks do better in August and September. They're not so far. We've got the growth stocks breaking out again on a relative basis. So I think if we get past this next month, this is the upcoming month, next 5 weeks, let's get through September, because I think if we get through September, I really believe heading into the October earnings reports, we're going to see another surge to the upside in these growth stocks as we approach their next earnings reports. All right, that's it. Everybody have a great day. I'll be back tomorrow over at Stock Charts for the next Trading Places Live. Have a great day. Happy trading, everyone.